There comes a moment in every trader's journey that no YouTube strategy video prepares you for. A moment where the charts are open, your account balance is staring back at you, and suddenly, confidence disappears. You hesitate. You second guess. You feel heavy before you even place the trade. If you've ever felt that, this message is for you. Forex is not just a market. It is a mirror. It reflects your patience, your discipline, your fear, your ego, and your emotional weaknesses with brutal honesty. That's why so many people quit. Not because Forex doesn't work, not because the market is rigged, but because trading forces you to confront yourself every single day. Most traders come into this market thinking the enemy is the chart. They think the enemy is volatility, news, or manipulation. But the real enemy is emotional decision-making under pressure. You can have the best strategy in the world. You can understand market structure, liquidity, supply, and demand. But if you cannot control yourself when money is on the line, none of that matters. The market does not reward intelligence. It rewards discipline, and discipline is rare. You see, anyone can be patient when they are not in trade. Anyone can follow rules when they are watching from the sidelines. But the moment price moves against you, emotions wake up. Fear whispers, close early. Greed whispers, add more. Ego whispers, you can't be wrong. And this is where most accounts are destroyed. Not by one big loss, but by many small moments of undisciplined behavior. Most traders don't blow accounts in a single day. They bleed slowly. Overtrading, ignoring rules, revenge trading, chasing moves they missed. And then they wonder why consistency feels impossible. Here is the truth no one likes to admit. The market is not your problem. Your reactions are. Professional traders are not emotionless. They feel fear. They feel doubt. They feel frustration. The difference is they do not allow emotions to control their actions. They understand something beginners don't. You don't get paid for being right. You get paid for managing risk. A trader who controls risk survives long enough to grow. A trader who ignores it eventually disappears. If you're still here, still trying, still learning, that already puts you ahead of most people who gave up too early. But effort alone is not enough. You must evolve. This journey will demand patience you didn't know you needed. It will demand discipline when motivation is gone. And it will demand humility when your ego wants control. This is not a get-rich-quick game. This is a long-term skill built through repetition, losses, and self-mastery. And if you can stay long enough, if you can learn to respect the process, this market will eventually respect you back. But first, you must survive it. Most traders don't fail at the beginning. They fail right before things start to make sense. This is the most dangerous stage of the journey. You're no longer completely clueless. You understand setups. You recognize patterns. You've had wins that prove trading can work. But you're still inconsistent. And that inconsistency slowly drains your confidence. One week you feel unstoppable. The next week you question everything. You start asking yourself if you're really meant for this. This is where most traders quit. Not because they can't trade, but because progress feels invisible. What no one tells you is that consistency does not arrive loudly. It doesn't announce itself. It sneaks in quietly after months of doing the same boring things correctly. The market tests you here. It gives you just enough success to keep you hopeful, and just enough losses to make you doubt yourself. And your response to this phase decides everything. Some traders panic. They change strategies again. They jump from system to system looking for certainty. They mistake discomfort for failure. But discomfort is not failure. It is growth. At this stage, the market is not asking you to learn more. It is asking you to behave better. Your entries might already be good. Your problem is execution. Your problem is discipline after entry. Your problem is how you handle being wrong. Most traders sabotage themselves in three ways. First, they trade too much. They confuse activity with progress. They believe more trades mean more opportunity, but more trades usually mean more mistakes. Second, they interfere with trades emotionally. They close winners early out of fear. They let losers run out of hope. They don't trust their plan when it matters most. Third, they chase recovery. After a loss, they rush to make the money back. They increase risk. They lower standards. And they turn a small loss into a big one. This is not bad luck. This is emotional immaturity. Professional traders understand something simple. Your job is not to win today. Your job is to execute correctly today. Wins are a side effect of discipline. When you focus on money, emotions take over. When you focus on process, consistency follows. You must accept this truth. Some days the market will not pay you, and that's okay. You don't get paid for effort. You get paid for patience. This stage of trading feels lonely because progress is internal. No one sees you skipping bad setups. No one sees you respecting risk. No one sees you staying out of the market. But the account sees it, and over time, the account reflects it. If you quit now, you'll never know how close you were. If you stay properly. Refine execution. Reduce risk. Trade less. Journal honestly. The trader you are becoming is built here. In silence. In frustration. In discipline. This phase is not punishment. It is preparation. And those who survive it separate themselves forever. There's a version of you that trades perfectly on demo. Calm. Patient. Disciplined. And then there is the version of you that trades real money. That version feels pressure. The moment money is involved, everything changes. Your heart rate increases. Your focus narrows. Your emotions attach themselves to every candle. This is where theory meets reality. The market does not change when you go live. You do. And this is why emotional control is the real edge. Most traders believe emotions are the problem. They try to eliminate fear and greed. But professionals know something different. Emotions never disappear. They are managed. Fear is not weakness. Fear is information. It tells you that something matters to you. The mistake is allowing fear to control your actions. Greed is not evil. It is ambition without structure. When unchecked, it destroys discipline. When money is on the line, your brain shifts into survival mode. It wants certainty. It wants relief. It wants control. But the market offers none of that. This is why traders do irrational things under pressure. They move stop losses further away. They add to losing positions. They close winning trades too early. Not because they don't know better, but because emotions override logic. The goal is not to feel nothing. The goal is to act correctly despite feeling something. Professional traders build systems to protect themselves from themselves. They predefine risk before entry. They accept the loss before clicking buy or sell. They understand that once in a trade, the outcome is out of their control. Control exists only in execution. If you enter a trade hoping instead of accepting risk, you're already compromised. Hope is not a strategy. Hope is emotional exposure. This is why risk management is psychological armor. Small risk keeps emotion small. Large risk magnifies every mistake. If your heart is racing during trades, your risk is too high. If you cannot sleep with a position open, your risk is too high. If one trade can ruin your week, your risk is too high. There is no shame in trading small. There is danger in trading emotionally. The market does not care about your confidence. It cares about your consistency. Every time you follow your rules under pressure, you train yourself to trust your process. Every time you break them, you reinforce emotional behavior. Consistency is built through repetition, not motivation. The trader who survives long enough to master emotions eventually realizes the market is not something to conquer. It is something to cooperate with. When you stop fighting price, when you stop forcing outcomes, trading becomes simpler, not easier, but clearer. And clarity is where growth begins. Most traders underestimate the importance of survival. They're obsessed with growth, returns, and fast results. But in trading, survival comes first. If you cannot protect your account, you will never scale it. Small accounts are not a disadvantage. Undisciplined behavior is. Many traders treat small accounts carelessly. They increase lot size. They overtrade. They gamble, telling themselves they can always start again. This mindset destroys more traders than bad strategies ever could. A small account is not meant to make you rich. It is meant to teach you discipline. If you cannot manage a small account properly, you will not magically manage a large one better. Bad habits scale faster than profits. Professional traders respect risk above everything, not because they fear losses, but because they understand probability. They know that any single trade means nothing. What matters is the series of trades. Your edge does not play out in one position. It plays out over time. This is why risk must remain consistent, not emotional, not reactive. When traders increase risk after a loss, they're not trading. They're trying to heal emotionally with money. And the market does not offer emotional relief. It offers consequences. Risk management is not about avoiding losses. It is about controlling damage. A trader who risks too much is one mistake away from destruction. A trader who risks properly can be wrong many times and still survive. This is the freedom discipline gives you. When risk is controlled, losses no longer scare you. They become acceptable costs of doing business. This changes how you think. You stop chasing trades. You stop forcing setups. You stop needing the market to behave a certain way. Instead, you wait. Waiting is uncomfortable. Waiting feels unproductive. But waiting protects capital. Capital is opportunity. Every time you enter a low-quality trade, you are spending opportunity. Every time you overtrade, you are paying tuition again for lessons you already learned. Trading is a game of patience disguised as a game of skill. You don't need to trade every day. You don't need to trade every session. You need to trade when your rules align. Professionals do not measure success by daily profit. They measure success by rule compliance. Did you follow your plan? Did you respect risk? Did you stay disciplined under pressure? If the answer is yes, the trade was a success, regardless of outcome. This mindset is what separates amateurs from professionals. The market does not reward excitement. It rewards restraint. And if you can master restraint, growth becomes inevitable. Losses are the part of trading no one wants to talk about. Everyone posts wins. Everyone celebrates profits. But losses are where traders are truly shaped. If you trade long enough, you will experience drawdowns. Not once, not twice, repeatedly. And how you respond to them defines your future. Most traders panic during losses. They question their strategy. They question themselves. They abandon rules that worked before. This reaction is natural, but it is also destructive. A drawdown does not mean your edge is gone. It means probability is playing out. No strategy wins all the time. Expecting otherwise is emotional immaturity. Professional traders prepare mentally for losses before they happen. They expect them. They accept them. They plan for them. This is why they don't overreact when a losing streak appears. Losses hurt most when your identity is attached to outcomes. When every trade feels like a judgment on your intelligence or worth. This is dangerous. You are not your last trade. You are not your last week. You are the result of your habits over time. Drawdowns expose weaknesses in mindset. They reveal whether you trust your process or chase emotional relief. Many traders try to trade their way out of pain. They increase frequency. They increase risk. They abandon patience. But pain cannot be traded away. It must be processed. Sometimes the best trade is stepping back, reducing size, reviewing execution, resetting mentally. Slowing down is not quitting. It is protecting your future. Professional traders understand cycles. They know that confidence and doubt both come and go. They do not let either dictate behavior. After a loss, their focus shifts to one question only. Did I execute correctly? If the answer is yes, the loss is accepted. If the answer is no, the mistake is corrected. Emotion is removed from evaluation. This is what maturity looks like in trading. Drawdowns feel personal, but they are not. They are mathematical. The market does not know you exist. It is not targeting you. It is not punishing you. When you stop taking losses personally, recovery becomes possible. Consistency is not built during winning streaks. It is built during drawdowns. Because discipline under pressure is what lasts. If you can survive the emotional weight of losses without breaking your rules, you're closer than you think. Patience is the most misunderstood skill in trading. Many traders think patience means doing nothing. But real patience is active restraint. It is choosing not to trade when conditions are not right. It is waiting while others rush. It is protecting capital while the market tempts you with noise. Most traders lose money not because they took bad setups, but because they took too many average ones. The market is open every day. Opportunities are not. High probability setups are rare by design. If they were common, everyone would be profitable. Yet many traders feel uncomfortable when they are not in a trade. They feel like they're missing out. They feel unproductive. This emotional discomfort pushes them into low-quality decisions. Professional traders understand something simple. Being flat is a position. Waiting is part of the strategy. They don't chase candles. They don't force entries. They allow price to come to them. And when it doesn't, they do nothing. This is not weakness. This is discipline. High probability thinking means accepting that most of the time, the best action is no action. It means understanding that one clean setup is worth more than 10 rush trades. It means being selective, not desperate. Patience protects you from yourself. When you wait, emotions calm down. You see the market more clearly. You make decisions based on structure, not impulse. Impatience creates mistakes. Mistakes create losses. Losses create emotional trading. It's a cycle, and patience is how you break it. Professional traders are not addicted to action. They are addicted to execution quality. They would rather miss a trade than take a bad one. They understand that missed opportunities cost nothing. Bad trades cost capital and confidence. If you feel the urge to trade out of boredom, that is not intuition. That is emotional hunger. Trading should feel boring most of the time. When it feels exciting, something is wrong. Excitement usually means risk is too high, or a discipline is slipping. The goal is not adrenaline. The goal is consistency. Every time you wait for confirmation, you strengthen discipline. Every time you skip a bad setup, you protect your edge. Patience compounds silently. The trader who waits properly does not need many trades. They need the right ones. And when they appear, they execute calmly, without hesitation, without fear, without forcing. This is how probability works in your favor. Not by speed, not by volume, but by restraint. Almost every serious trader has blown an account. Not once, sometimes more than once. And for many, that moment feels like the end. The balance hits zero. The screen feels quiet, and a heavy question appears. Was it all a waste? This is where traders are divided. Some walk away permanently, carrying bitterness and regret. Others use the experience as a turning point. Blowing an account does not mean you failed. It means you reached a limit without the discipline to support growth. The market did not betray you. It exposed you. Failure in trading is rarely about intelligence. It is about behavior under pressure. Most blown accounts share the same story. Too much risk, too little patience. Emotional decision-making disguised as confidence. The painful truth is this: you cannot skip emotional maturity. The market will demand it sooner or later. After an account is blown, many traders rush back in. They deposit again, hoping to recover pride. They trade aggressively, driven by emotion. This is the worst possible response. Rebuilding starts with honesty. You must look at what happened without excuses. Not blaming news. Not blaming brokers. Not blaming the market. Just behavior. Did you follow rules? Did you respect risk? Did you trade out of boredom or desperation? Growth begins when excuses end. Blown accounts are expensive lessons. But lessons only matter if they change behavior. Professional traders are not those who never failed. They are those who failed correctly. They reduced size. They slowed down. They rebuilt discipline before rebuilding capital. Starting small is not humiliation. It is intelligence. Trading small removes emotional pressure. It allows clarity to return. It creates space to rebuild trust in yourself. Confidence is not built by winning big. It is built by executing correctly again and again. After failure, you must redefine success. Success is no longer profit. Success is discipline. One trade executed correctly is progress. One day without breaking rules is progress. The trader you become after failure is stronger. If you choose reflection over revenge, this market does not reward stubbornness. It rewards adaptation. If you are still here after failure, that means something inside you refuses to quit. That is not weakness. That is potential. But potential must be shaped. Rebuild slowly. Trade smaller. Think clearer. Failure is not the end of your journey. It is the moment your journey becomes serious. Ego is the most dangerous indicator in trading. It does not appear on your chart, but it influences every decision you make. Ego whispers that you are better than your rules. It convinces you that this time is different, that you can bend the plan just once. And once is all it takes. Overconfidence often arrives after a winning streak. Trades start working, the account grows, and discipline quietly weakens. This is how accounts die slowly. When traders start to feel invincible, they increase risk without justification. They skip confirmations. They trade out of excitement instead of patience. Ego feeds on success, but the market does not care about your confidence. It only responds to probability. Professional traders are careful during winning periods. They know success can be more dangerous than failure. Failure humbles you. Success tempts you. Ego also shows up when traders refuse to accept being wrong. They hold losing trades longer than planned. They widen stop losses. They argue with price instead of respecting it. This is not analysis. This is emotional attachment. The market is never wrong. Your timing can be. Your bias can be. Your execution can be. Letting go of being right is a requirement for longevity. Another silent killer is the need to impress. Trading to prove something to friends, to social media, or to yourself. This turns trading into performance, not process. Professional traders trade privately, quietly. They don't need validation. They measure success internally, by rule execution, not applause. Ego also appears in refusing to adapt. Markets change. Conditions shift. What worked before may slow down. Adaptation is not weakness. It is survival. Rigid traders break. Flexible traders last. The moment you think you have mastered the market reminds you that you haven't. Humility is not optional in trading. It is protection. When you accept that you will always be a student of the market, you stop fighting it. You start listening. The most dangerous trader is not the beginner. It is the trader who thinks they are finished learning. If you can keep ego in check, respect rules during winning streaks, and accept being wrong quickly, you remove one of the biggest obstacles to consistency. And consistency is built quietly, without ego, without drama, without force. Consistency is the ultimate edge in trading. Not strategy, not indicators, not luck. Consistency is what separates traders who survive from those who fail. Most traders chase excitement. They think a good trade is measured by the money they make. But professional traders measure success by behavior. Did you follow the rules today? Did you manage risk? Did you execute calmly? If the answer is yes, the day is a success, regardless of profit or loss. Habits are the building blocks of consistency. Small habits, repeated daily, compound silently. Logging trades, reviewing performance, following risk parameters, skipping bad setups. These habits feel boring. They feel small. They feel invisible. And that is exactly why they work. Discipline is built one boring day at a time. Consistency is forged in repetition, not adrenaline. Most traders fail because they rely on motivation instead of habit. Motivation is temporary. Habit is permanent. You cannot rely on excitement to follow rules. You must build systems that enforce them, even when emotions scream. The daily mindset of a trader is simple. Protect capital. Respect probability. Execute with patience. Record everything. Learn every day. Even on losing days, there is value. Even on frustrating days, discipline strengthens. Even when the market feels unfair, your habits hold you accountable. Consistency is also about staying present. Stop comparing your account to others. Stop obsessing over news and predictions. Stop looking for shortcuts. Focus on the trades in front of you, the rules you designed, the risk you can control. Every day you repeat good behavior. You're training your brain to react correctly under pressure. You're building confidence in your process, not your luck. The trader who survives long-term is not the one with the flashiest wins. It is the one who shows up every day, follows rules, respects risk, and executes consistently. Patience, discipline, and repetition. These are your real indicators. This is your edge. This is what separates a professional from an amateur. The market is not your enemy. It is not something to conquer. It is something to respect. Most traders approach Forex like a battle, trying to force outcomes, to prove themselves, to beat price. And this is why so many fail. Professional traders approach it differently. They study structure. They identify probability. They respect price movement. They understand that every candle tells a story, and ignoring that story leads to emotional mistakes. Market respect is knowing when to trade and when to stay out. It is not taking every signal, not chasing every spike, not acting on fear or greed. It is observing, waiting, executing only when rules align perfectly. Structure is key. Support and resistance, trend, momentum. These are not just technical terms. They are guides. They tell you where price may react, where risk is acceptable, and where patience will pay off. A professional sees high probability setups, not guaranteed wins. They understand that probability favors them over time, but each individual trade is uncertain. This mindset protects against overconfidence. It protects against revenge trading. It protects against ego-driven decisions. Thinking like a professional also means respecting your capital. Every account has limits. Every position carries risk. Overstepping those boundaries is the fastest route to destruction. Patience, structure, and respect create freedom. Freedom to take the right trades without desperation. Freedom to let go of losing trades without panic. Freedom to stay disciplined when others are emotional. The market does not reward bravado. It rewards preparation. It rewards observation. It rewards restraint. One clear observation, one disciplined entry, one small controlled trade can be worth more than dozens of rush trades. Professionals know that profits are a byproduct. Discipline is the main product. Consistency is the method. Respect is the foundation. The moment you stop fighting the market, stop trying to be smarter than it, and start observing it like a professional, everything changes. Your mindset shifts from chasing outcomes to controlling what you can, your behavior, your risk, your rules. And this shift is invisible to most traders, but it is what separates the ones who survive from the ones who quit. Respect the market. Follow structure. Trade like a professional, and your consistency will follow naturally. Winning streaks are dangerous in disguise. They feel good. They boost confidence. They make you believe the market is easy. But overconfidence during a streak is a silent killer. Many traders start increasing risk. They skip rules. They chase bigger profits. And just like that, a streak can vanish in a single mistake. Professional traders treat winning streaks with respect. They do not inflate risk or abandon discipline. They continue executing rules carefully. They maintain consistency. Mental balance is everything. One profitable week does not make you a professional. One profitable month does not guarantee the next. Success is built slowly, quietly, trade by trade, day by day. And it is maintained through humility. It is easy to forget the lessons learned during losses when the money is rolling in. This is why mental balance is critical. It prevents pride from corrupting discipline. Professional traders understand that each trade is independent. They do not let past wins influence future decisions. They do not believe they are untouchable. They do not become slaves to emotion. A winning streak should never change your approach. It should reinforce good habits, confirm that rules work, strengthen patience and execution. Avoid complacency. The market does not reward arrogance. It punishes it. Keep risk consistent. Keep position size under control. Keep your rules sacred. Observe, wait, execute. The same way you did during losses. This balance of humility and discipline is what allows profits to compound over time. It is what turns small, consistent gains into long-term success. Celebrate wins internally, quietly. Reflect on mistakes openly, honestly. This is the mindset that builds longevity in trading. Remember, the market is not here to make you feel good. It is here to test your character, your discipline, your patience. Handle winning streaks like a professional. Keep your mind balanced. Keep your ego in check. And the market will reward you over the long term, not in flashes of luck, but through consistent growth that lasts a lifetime. This is the final truth every trader must accept. Trading is not about quick wins, flashy profits, or proving yourself to anyone. It is about becoming the type of person the market respects. The market rewards discipline, patience, consistency, and humility. It does not reward emotion, ego, or impatience. If you chase outcomes, you will be punished. If you chase process, you will succeed. Every trade, every day, every decision builds your long-term edge. Your account is a reflection of your behavior, not your luck. Your results are the side effect of habits, mindset, and discipline. Think long-term. The trader who survives is the trader who plays the game correctly for months, years, and decades. The short-term thrill is meaningless. The long-term mastery is everything. Visualize the trader you want to become. Not the trader who made a few lucky trades. Not the trader who follows hype. The trader who executes with patience, respects risk, and learns from every mistake. Your journey will be uncomfortable. You will feel fear. You will experience doubt. You will face losses and frustration. This is normal. This is growth. The difference between a consistent trader and one who quits is simple. The consistent trader controls what they can, their decisions. They accept what they cannot, market outcomes. They persist. They adapt. They improve. Money is temporary. Accounts come and go. But skill and discipline last forever. Every time you skip a bad trade, you strengthen your edge. Every time you follow rules during pressure, you reinforce discipline. Every time you learn from mistakes instead of repeating them, you build mastery. The market will challenge you. It will test your patience, your confidence, and your mindset. Some days will feel impossible. Some losses will feel personal. But the trader who survives is the one who keeps showing up. The one who focuses on process instead of outcome. The one who respects the market and themselves. Remember, you're not here to get rich fast. You are here to become consistent. You are here to master yourself. And when you do that, the market will follow. Long-term vision, discipline, and mental resilience. These are your true edge. Everything else is noise. So take a deep breath. Refocus. Start again. Trade like a professional. And never forget, consistency changes everything.